why it is so important to invest in cash flowing assets and how they can help you achieve financial freedom significantly faster than other investment vehicles. Sounds pretty obvious, right? Obviously, you want to invest in cash flowing assets, but let's actually get into it and talk about a couple examples and analogies that I think will help lay out why cash flow is so incredibly important and superior to other investing styles. Let's get into it. But of course, if you haven't done so yet, make sure to invest in the subscribe button right down below the video. Thank you. I really appreciate it. And let's get into it. But of course, I need to preface the video by saying I am not giving you investing advice at all, but rather hopefully giving you some ideas and getting you thinking a little bit about cash flowing assets versus just traditional investment styles like so many other people invest in. So with that being said, let's jump into this. Now in this video, I'm going to give you two different examples of cash flowing assets. First off, there are so many different ways and investments that you can actually invest in that are cash flowing. However, for the purposes of this video, I'm only going to use two different examples. And then I'm actually going to be giving you two different analogies also that I think will really help paint a picture of what I actually mean, why cash flow is so incredibly important other investing styles. All right, so let's talk about the two different methods of cash flowing assets that I'm talking about investing in. Now again, you can figure out whatever works best for you and your style. I'm just simply using these as examples. Number one, rental real estate. Cash flowing, positive cash flowing, rental real estate. And the other type would be dividend paying stocks. Of course, the dividend paying on a quarterly basis would then be the so-called cash flow, right? The return on your investment that you'd be getting every single quarter, quarter after quarter, for as long as you own that equity, right? All right, so let's jump into this and talk about why these are so much better than other traditional assets, or investments more like I should say. So here's the thing first off with assets. There's a miscommunication about assets out there. Of course, everybody can identify assets as something different, but here's how I identify assets. Something that is going to continuously pay you. There's a lot of people out there that say, my car is an asset. No, according to my definition, your car would be a massive liability. A lot of people say, my house is an asset. No, your house is not an asset, but rather it is a massive liability. Some people say, my watch is an asset. No, sorry, your watch is not an asset. It is a liability, once again. Here's the thing. I like to go off of the definition identified by Robert Kiyosaki, which is what an asset is. Is it something that puts money in your pocket? An asset is something that pays you, whereas a liability takes money from you. So here's the thing. Let's run through those couple quick examples really quickly so we have a better idea of what an asset actually is. Your car, does it pay you? No, not at all, right? It just sucks money right out of your pocket like a siphon, right? For gas, insurance, maintenance, repairs, that thing is taking money out of your pocket probably every single week. Therefore, is it an asset or a liability? Well, by our definition, it is a liability, and it is a big one at that. How about a house? The house that you live in, is it an asset or liability? Well, a lot of people say it's an asset. Well, according to this definition, no. It would actually be a liability simply because of the taxes, the upkeep, the management, the repairs, all of everything that you need to put into the house, unless it is actually paying you, like as in maybe you have a roommate or somebody that rents out the basement or another section of the house. Maybe then you could call it an asset, provided, let's say, your liability on the property is maybe $1,000 a month and maybe your tenant pays you $1,500, well then yes, your house could potentially be an asset at that point because you're taking in more money than what you're actually paying out on a monthly basis, right? So anyway, you get it, right? Something that puts money in your pocket would then be an asset versus a liability that just continuously takes money out of your pocket, right? Like kids, they're liabilities because they're constantly taking your money, right? I know because I have one that is only about 6 months old now. So yeah. She is constantly siphoning money out of Dad's pocket. I know what it's like. All right, so anyway, let's get into it and talk about why cash flowing assets are so much more superior. Now, here's the thing. Now that we have a definition of an asset, right? A cash flowing asset. Let's look at a rental property. Okay. And all this is going to come full circle here in just a second. When I give you these couple analogies, I think it's all going to come full circle, and you're going to better understand why these are so much better. All right, so let's look at this. a rental property. Maybe rental properties are your thing, maybe they're not. It doesn't really matter. Let's just look at it for the value in this example versus just looking at it as a rental, okay? So you have a rental property. Your liability on the property, as in PITI, principal, interest, taxes, insurance. In other words, your mortgage on the property, your taxes, your insurance, your upkeep, your management. Let's just say all of that combined is $1,000 per month. Meanwhile, you've placed a tenant into the property and they're paying you $1,500 per month. Therefore, you have a positive cash flow. After you take your rental income in and you pay out your liabilities, you have a positive cash flow of $500 per month. Not bad, right? You get to take that $500, put it right in your pocket, and do whatever you want with it. It doesn't really matter. You do not need to put it in the property. You can take that money and spend it on whatever you want, or you can save it. Now, here's the thing. One property is great, but let's just say, for example, you have 5 properties. Well, all of a sudden, your $500 per month per property on 5 properties all of a sudden goes to $2,500 per month. Let's just say you have 10 properties, all of which positive cash flow, $500 per month. Well, now you've got $5,000 of positive cash flow every single month after you've paid for all of your expenses. Get what I'm saying? So do you start to understand why positive cash flowing assets are so incredibly important versus a traditional asset like, let's just say, a stock? Does a stock pay you every single month? No, unless it is paying you a dividend on a quarterly basis. Dividends would pay you on a quarterly basis, which is also one of the examples I gave of an asset, right? Because it pays you on a quarterly basis your dividend. Based on the amount of shares that you have and the dividend that it's paying at the time, there you go. You get paid every single quarter. But let's just talk about any other stock that does not pay a dividend. Are you getting paid by owning that stock? No. You're getting some price appreciation, maybe, hopefully, or price depreciation, right? So here's the thing. That stock is not paying you. It is not an asset. It's an investment. Yes, don't get me wrong. It's an investment. But other than that, it would not be within the definition of what we've called an asset, right? It is not continuously paying you on a monthly, quarterly, semi-annual, or annual basis, unless you get price appreciation, but then you can't really bank on that, right? So, with that being said, can you start to see why a cash flowing asset like a rental property would actually be more superior to like a stock investment where you're getting nothing other than appreciation, which, by the way, on a rental property, not only are you getting positive cash flow, you're also getting all the tax advantages and you are also getting price appreciation just like you're getting with a stock or an ETF, right? So it's kind of like the triple whammy, right? The trifecta, right? You get what I'm saying? Like it's like the 3 different ways that you can benefit from a rental property, or basically any other asset. All right, so let's talk about a couple analogies now of why cash flowing assets can actually be so incredibly powerful and how it can build financial freedom incredibly fast versus just buying a bunch of stocks. Now, don't get me wrong. Stocks can be a really good investment. In fact, if you get into the right ones at the right time, you can make a really nice return on your money over a very short period of time. However, that's typically not the case for most people. Most people get in the wrong time and get out the wrong time, right? They buy at the top and sell at the bottom. That's typically how most people invest in stocks. It's just the nature of the game. But let's talk about a couple analogies now. All right. So this would be an analogy when it comes to a cash flowing asset portfolio. Whether you have one cash flowing asset or maybe you have 500, doesn't really matter, but it's just a bigger scale, right? Bigger numbers, more commas, more zeros, basically all the same thing. Or I shouldn't say zeros, more digits, right? We don't want to look at zeros. Zeros mean the same. Regardless of how many commas you have, 0 is still 0. Yeah, let's look at digits rather. Okay, so anyway, let's look at this analogy. It is like the snowball effect. Visualize this, a huge mountain. At the very top of the mountain, there's a bunch of snow, right? Well, at the very top of the mountain, a little snowball begins to form. He starts out really teeny tiny, right? Like the size of a pea, right? Like a pea that you eat. He starts out that big. He's a little tiny ball. That's kind of like a cash flowing asset. That's one rental property, okay? So he starts sitting there, he's making himself a little bit bigger. Eventually, over time, he makes himself the size of about a ping pong ball or maybe a golf ball, right? He starts rolling very, very slowly down the mountain. Here's the thing. He starts rolling down, he makes it about 20 feet. Then he picks up another rental property, otherwise known as another cash flowing asset, and he grows in size from the size of a golf ball all the way up to the size of a softball, right? He's tripled in size, right? Or more than that probably, but he's gotten a lot bigger. All of a sudden he starts rolling a little bit faster and he starts getting a little bit more speed. Well, all of a sudden he makes it another 20 feet, and again, he doubles in size and he goes from the size of a softball up to, let's just say, like a volleyball size, right? He's doubled, tripled, or something, quadrupled in size. Kind of like the same as going from one rental property, from where he was at the top of the mountain, where he was a little P, all of a sudden he picked up another rental property, where he's now 2, and now he's gone down and he's picked up a 3rd, where all this cash flow is starting to build rapidly. So now he's the size of about a volleyball. Okay, he keeps rolling down the mountain a little bit faster. He's gaining more speed, more momentum, and he's gaining even more power as he goes down the hill because he's getting bigger, right? The bigger he gets, the more powerful he becomes. All right, so little snowball man, he's rolling down the mountain. He goes down another 20 feet, let's say, or let's just say another 50 feet. He's gained a lot of steam this time. He's gone from a volleyball, now all of a sudden he's the size of a beach ball. Again, he's tripled in size or quadrupled in size. He's gaining way more speed and momentum. He's getting huge at this point. He's getting really big, and he's getting a lot of weight behind him. He's getting a lot of momentum, and he's getting a lot more speed towards his trajectory. It's just like rental properties, okay? Or any cash flowing asset. I'm just using rental properties as an example. There are many different ways that you can approach this. So here's the thing. You went from 1 rental to 2 to 3, and now let's just say you're up to 6, right? All of a sudden, you're the size of a beach ball, and you've got 6 rental properties, right? You've got it cooking, and you've got it going on. Well, let's go back to the volleyball or the snowball that's the size of a volleyball now. Okay, so he keeps rolling. He's getting a ton of speed, and he keeps rolling down the mountain faster and faster and faster. The faster he gets going down that mountain, the faster he continues to build and grow his size. Well, let's just say he rolls another 100 feet. Now he's the size of a massive truck, right? He's the size of, let's just say, a Ford F-150. I don't know, just the first truck I can think of. Okay, so he's the size of a Ford F-150. Obviously, he's round, not a big rectangle. Anyway, he is huge at this point. Let's just say you've gone from 6 rental properties all the way up to 20. At that point, you're getting so much cash flow on a monthly basis that it's literally the snowball effect. You start out really slow and small until you start to get so much momentum, speed, and power behind your movement that all of a sudden you get to the point where it's like critical mass, where you can literally start moving into just about anything rapidly because you're getting so much cash flow thrown off from your 20 properties, right? You kind of get what I'm saying? The faster that you get moving and the more cash flow that you get from all of your properties, because you start building more properties on top of each other because of all the cash flow you're getting, all of a sudden you're like that snowball working his way down the mountain. By the time you get to the bottom, or by the time you get to, say, 20, 30, 50 properties, or maybe even more, 100 properties, it's literally gotten so big and you have so much cash flow being thrown off from your properties. You could literally be picking up new houses like on a regular basis. Probably every single month you could be buying another house, probably in cash if you just so wanted to do so, right? So it's kind of like the snowball effect. Starts out very slow and very small, but over time, as you continue to build with all of your cash flow from off of these cash flowing assets, rental properties like I'm talking about in this example, you start to build your wealth incredibly fast. Now let's quickly talk. So first off, I think you understand the snowball effect, right? The faster it starts moving down that mountain, the faster, the more powerful it gets, just like the more properties you start picking up and the more cash flow you start to get, the more powerful you become as you move forward. Now let's look at a stock investment with no dividend payouts. How does that relate to the snowball effect? It doesn't. It doesn't at all, right? It's not throwing off any cash. It's not doing anything, right? It's just sitting there with price appreciation, and that's about it. That is about all that it is doing, a price appreciation. And once you sell, oh, guess what? Now you have to pay taxes at a rate of about 40% on your capital gains. Ouch. There goes the snowball effect, right? Yeah, that's not going to do much for you. You've just booked a nice big profit, and all of a sudden you sell it, and you give 40% of it away. Yeah, that's not how you build wealth. No. Anyway, I wanted to lay this analogy out. I wanted to lay this whole situation out as far as why assets are so much more important and how they can help you build financial freedom so much more faster than just other traditional assets or other traditional investments like maybe stock or ETF investing. And heaven forbid, mutual fund investing. Oh man, I hope you're not doing that. If you are, please read some books, do some research. Yeah, you want to stay away from those guys. But again, whatever works for your personality and your investing style. Anyway, hope this helps you out to kind of paint the picture of why asset investing in cash flowing assets is so much more important and how it can actually help you build financial freedom so much faster than other just traditional investments that so many people talk about. Of course, I can come back and talk about this in much more detail in further videos, but I kind of just wanted to hit on this and kind of play around with some different ideas, some different analogies, and some different examples explaining why cash flow is ultimately king and will help you so much faster achieve your financial goals. So, make sure to hit that subscribe button, or maybe I should say, invest in the subscribe button right down below the video. Feel free to share this one, or go back and check out any of my other nearly 1,400 videos right here on the channel. Thanks again, I truly appreciate it, and I'll catch you again